All right, let's talk about the U.S. warehouse market. If you've been following the headlines, you'd think the sky is falling. Everything points to a major slowdown. But what if I told you that beneath all that noise, there's a huge rebalance happening, and that this shift is creating an incredible opportunity in a city you might not expect?
So this is the big question, right? Is the warehouse real estate boom finally over? I mean, after years of just absolutely explosive growth, it really does feel like the party might be winding down for industrial real estate. You see the same headlines I do, you hear the chatter, and it all seems to be pointing in one direction, a big, looming market correction. And hey, if you look at the national numbers, they seem to back up those fears. I mean, look at this. National vacancy is at 11.2%. That's the highest it's been since 2011. New supply? It's basically fallen off a cliff. And get this, for the first time in ages, asking rents are actually going down, negative 4.1% year over year. Yeah, on the surface, this looks pretty grim.
But what if we're all reading the map completely wrong? What if this isn't a crash at all? What if it's something else, something necessary? A shift that's actually creating one of the single best buying opportunities we have seen in a very long time.
So let's give it a name. Let's call it the rebalance. Look, this is not a catastrophe. It's just the market finally coming back down to earth, returning to a healthy, sustainable average after a few years of, let's be honest, absolutely insane, off-the-charts growth. And here's the key takeaway, this whole rebalance thing. It's actually putting the power right back where it belongs, in the hands of the buyers.
You know, a great way to think about it is like this. Those crazy low 3–4% vacancy rates we saw a couple of years back, that was like a rubber band stretched way, way too far. I mean, to its absolute limit. That was never going to last. It had to snap back to a more normal, healthy tension. And that's exactly what we're seeing happen right now. Okay, so what does this snapback actually mean for you, for the savvy investor? Well, it boils down to three really big things. First, you've got pricing leverage again, finally. Second, since new construction has pretty much ground to a halt, you're looking at almost zero new competition coming online for the next 1.5 to 3 years. And third, and this is the big one, all of this is just perfectly setting the table for the next major cycle of rent growth.
Now here's where it gets really interesting. While most of the country is kind of hitting the pause button, waiting to see what happens, there's one city that isn't just surviving this rebalance. Oh no, it is perfectly positioned to thrive because of it. And that city is Indianapolis. So let's dive in and take a look at how central Indiana is completely defying the national trend and what makes it such a fascinating outlier.
So what's going on in Indy? Well, the story here is really being driven by two huge, very distinct engines of growth. And listen, these are not just some speculative trends or fuzzy forecasts. We're talking about concrete, on-the-ground forces that are creating just unbelievable demand for industrial space. Okay, engine number one. The pharmaceutical giant Eli Lilly is in the middle of a massive, multi-billion-dollar expansion. And the ripple effects from this is, well, it's staggering. We're talking about an estimated need for 15 to 20 million square feet of new warehouse and logistics space. Just think about that. That is an entire market's worth of demand coming from just one company's investment. It's wild. And that brings us to engine number two. And honestly, this might be the most important factor of them all. Duke Energy is pumping over $2 billion into upgrading the regional power grid. Now, I know. Upgrading the power grid sounds kind of boring, right? But trust me, in today's world, this is the secret ingredient. This is the superpower that every other market in the country wishes it had. Why? Because the rules of the game have completely changed. That old real estate mantra, location, 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 yeah, that's being replaced. The new number one, the most critical factor for modern site selection, is electrical power capacity. Think about it. Automation, robotics, the coming wave of EV truck charging, today's warehouses are becoming absolute power hogs. Seriously, it's not about highway access first anymore. It's about power. Just look at this quote. The very first question that every major national tenant asks is, how many megawatts can I get and how fast can you deliver it? If you don't have a solid answer to that question, you're not even in the game. The conversation is over before it starts. And this is why that Duke Energy investment is such a total game changer. Just look at the difference. In most US markets, if you need a serious amount of power, say 10 megawatts or more, for a new site, you're going to be waiting 3 to 5 years. In central Indiana,
They can get it to you in just 12 to 24 months. That's not just an advantage, that is a massive, almost unfair competitive edge in today's market.
Okay, so we have these huge macro forces at play. But how does that actually translate into real, on-the-ground, investable opportunities? Well, let's take a quick tour of the key submarkets around Indianapolis and see exactly where the action is. So you've got a few different ways to play this. The Northwest Corridor, that's your most established area. It's actually the tightest industrial market in the entire Midwest right now. Then you've got the Southwest, and that is all about that power advantage we just talked about. We're talking substations ready to deliver over 20 megawatts, like today. And if you're looking a little further down the road, the Northeast has the most affordable land, which makes it absolutely right for the next big wave of development. But okay, beyond the incredible demand and that unique power advantage, there is one more piece to this puzzle. And honestly, this is the financial argument that for a lot of people is going to be the real clincher. It's something we call the investor's margin of safety.
So, what exactly is a margin of safety? It's actually a pretty simple concept. It's the difference, the gap, between what it costs to build a brand new, top-of-the-line warehouse from scratch and the price you can pay to buy a very similar existing building right now.
And this chart, wow, it just lays that gap out in plain sight. Right now in Indianapolis, if you want to build new, it's going to cost you somewhere between $190 and $220 a square foot. But you can go out and buy an existing modern building today for just $120 to $155 a square foot. That huge difference, that is your margin of safety. That's your built-in cushion.
When you do the math, that gap translates to a massive 30 to 40% discount compared to replacement cost. I mean, that is pretty much the largest margin of safety an investor could hope for. It gives you this huge buffer against any short-term market wobbles, any noise about interest rates, really any other risks that might pop up.
So let's just pull it all together. Let's recap the Indianapolis advantage. Number one, you have enormous, pretty much locked-in demand from huge corporate expansions. Number two, you have an unmatched advantage in electrical power, which is fast becoming the number one resource for the future of logistics. And number three, you can buy in today at a 30 to 40% discount to what it costs to build new, giving you that powerful margin of safety. It's the whole package.
And all of this leaves us with one big final question to think about. As our supply chains get smarter, more automated, and as literally everything from trucks to forklifts goes electric, we're stepping into a world that's really going to be defined by its constraints. And in a world like that, you really have to ask yourself, is guaranteed quick access to massive amounts of electrical power the new gold? Because if you look at what's happening in Indianapolis, the answer seems to be a pretty resounding yes.